Now that tax season has just ended and having completed hundreds of personal and business tax returns, there have been common themes that I've seen in these tax returns for both individuals and businesses that tend to be IRS red flags. So in this video, I'm going to cover the top 10 IRS red flag areas to kind of be on alert for, especially if you're a business owner. And at the start of the presentation, I'll go through an IRS audit, what happens during an IRS audit, the two forms of an IRS audit. So if you have any questions, leave them in the comments below. I'll definitely respond to them. But again, these are the top 10 that we typically see and we warn our clients on. I thought I'd kind of share them with you. Thank you. Okay, so in this video, I'm going to cover the IRS audit, the two types, as well as going through the top 10 IRS red flags that we typically see when working on tax returns. So the first, IRS audit. So the old way that the IRS kind of interacts with its taxpayers is a face-to-face, and this could happen at the IRS offices or they can come to your office. Everything is kind of scheduled. You'll get a letter in the mail and they'll kind of schedule a time that works with you and them. And this is more kind of face to face. They'll kind of send you a list of documents that they'll want to take a look at, receipts, bank statements and all that. What's been popular recently, just because of COVID and everything else, is an audit through mail. So it's called a correspondence examination. What happens is, a business or an individual will receive a letter from the IRS saying we're going to do an audit on your 2021 tax return, for example, and we want to see these documents. And what you'll have to do is gather those documents and then mail them back to the IRS, or you can fax them. And then, the IRS will kind of review that information. If they have any further, questions, they'll send you another document in the mail. And you kind of go back and forth until they're satisfied. So again, this is by mail correspondence examination. Unfortunately, the IRS doesn't, have email. Now they are kind of building out their online portal where this correspondence can be done through the IRS portal. So if you have documents, you can upload it there. And I believe you can kind of like message them through the portal. But still it's all kind of through email or through mail. So those are the two types of audits. If you ever do get those letters, you want to make sure that, if you're not working with a CPA, you want to engage a CPA or an attorney that has IRS, expertise, because what can happen is you can give power of attorney to your CPA, and your CPA can act on your behalf because they're going to ask questions that you may not know the answers to, and it's better to kind of respond with a correct response versus saying something that could trigger something else. So that would be one recommendation. Again, if you're not working with a CPA or an attorney, you should kind of engage one if you're in this situation. So going through the top 10, the first one is not reporting your income. So if you get W-2s, if you sold any investments during the year, if you sold your house during the year, if you have investments like in a partnership or an SCorp, you're going to get K-1s, right? If you have dividend income, if you have interest income, if you have money sitting in a bank account earning interest income, you got to report that. And what we've told our clients is these banks aren't necessarily sending forms in the mail anymore, meaning that, back in the day, everyone would send forms, you kind of like your year-end tax forms that you have to report on your personal return. And that's not happening as much. So you're going to have to go to your bank, go online, download these year-end tax statements, and then use that in your personal tax return. So we've seen instances, and it wasn't the taxpayer trying to avoid reporting income. It was more of, they just forgot they had money sitting in a bank account, investments sitting in a bank account. And they never got a form in the mail. and thus they never report in their tax return. So this is one key thing. It's low hanging fruit. It's simple. Just report everything that you get. And you probably saw my video on the 1099K with PayPal, with Zelle. You know, if you're getting paid and it's for a business transaction, you're going to get a 1099K and you get it and the IRS gets it. So when the IRS gets it, they're expecting to see this in your tax return somewhere. So again, not reporting income could trigger an IRS audit. Another one, large swings in income. So just say 1 year your gross income was $250,000. The next year it was $200,000, and in the third year it was $50,000, right? That could trigger an audit because, you've been consistent at like 200,000, 250. Then there's this huge drop, right? On the flip side, just say you're doing 200, 250, and all of a sudden it goes up to a million, right? They may question, was prior years, not reported correctly, right? Were you kind of, missing some income back then? So, and things like this, there's an opportunity before you file your personal tax return is to add like a footnote or a note that the IRS gets, that you can kind of tell them, hey, this year I received this bonus, and it's all reported, and that's why this year is higher than last year, right? So that's one idea that you can do to kind of avoid any audit, is to kind of be upfront with everything. Number 3, excessive deductions and credits. So again, like charitable donations, right? And this kind of goes along with, number 4 here, where just say you've been, donating to charity and it's been like very consistent, $1,000 to, $3,000 every year. All of a sudden in 2022, you donate $20,000, right? This is something where you would attach one of those donation letters or all your donation letters to your tax return, and add a footnote saying, this year we donated so much to this organization and this is why the donations are higher, right? Because that's a deduction. And that could also be kind of questionable deductions, right? So, you kind of want to be upfront about all that. And also with questionable deductions is like the home office deduction or passive losses on rental properties. So if you are a W-2 employee and you've had to work from home, unfortunately, you can't take the home office deduction. And a lot of people have been doing this, and it's an easy, pick for the IRS because they're going to challenge that, right? There's no one in that household that owns a business, but for some reason they're taking the home office deduction. You can't do that. Same with rental properties and passive losses. Unless if you're a real estate professional, there's only so much in real estate losses that you can deduct in a given year, and how people kind of classify those losses. They're saying they're active, real estate professionals, and that alone could trigger an IRS audit too. So you just got to be careful on these two. Cash transactions. So with the Bank Secrecy Act, if you kind of deposit, $10,000 or more into your bank is going to report that to the IRS automatically. You're not going to get a form, right, from the bank or from the IRS. It's happening in the background. So if you're making all these large deposits or these large withdrawals from your bank account, the IRS pretty much knows about it. So, this is happening like a lot, like you're depositing, $100,000, if you're depositing like $15,000 and stuff, it's, the IRS knows about it. So you want to make sure that you got records on why you're doing this. And in case you ever get, caught for an IRS audit. Number 6, Schedule C, sole proprietors. So we tell every business owner, if you're starting a business and you're serious about this business, stay away from the Schedule C. of all the different types of like business entities out there, like SCorps, LLC partnerships, SCorps, Schedule C's get audited a lot. So why not kind of set up like an LLC partnership, bring in a family member as a second member, or even open up like an SCorp? You got some tax savings of that alone. But SCorps or Schedule C's, they get audited a lot because people have, historically kind of taken advantage of them. And it's more of, and this kind of dips into number 7 here, where someone really has like a hobby. They're spending all this money kind of creating this hobby. They might have a little bit of sales, but are they really do they really have like a trader business? And oftentimes they don't. And that's why the IRS kind of just looks at this Schedule C a lot. So, if you are going to go down the Schedule C sole proprietor, because remember, sole proprietor, you don't need to register. You don't need an EIN. You don't need to register with the IRS. All you do is you put your social security number. You don't need to register with the state. You essentially just start doing business. So, when you kind of go down the SCorp route or an LLC, you got to register with the IRS. You got to get an EIN. You got to register with the state. So there's extra steps that you're doing. And in the eyes of the IRS, they're probably thinking, oh, this is probably like a trader business because they're kind of going these extra steps. So just be careful. This, like I said, dips into number 7 here. Businesses that operate at a loss for, 3 or 4 years, you could be questioned as, is this truly a trader business, or is it a hobby, or is it, is the intent to make a profit in this business? And maybe it is, but you'll still get picked for an audit, and then they're going to look at all your accounting records. They're going to look at your bank statements. They're going to look at what they want to see, support for all these expenses that you're spending. So you may have a viable business. You may have a little bit of revenue, a bunch of expenses, but it's just going to trigger an audit. So, just be careful about this. And again, just rethink your whole Schedule C sole proprietor route. Number 8, round numbers. For some reason, there's people that use round numbers on their tax returns, and those kind of trigger an audit, right? So if you have truly $796 of software expenses, but you decide to round up to 800, why do that, right? And we recommend, if you're a business owner, to kind of use QuickBooks Online, Xero. There's a lot of accounting softwares out there that plug into your bank account, and you'll have a true balance sheet, true income statement with actual numbers. They're not going to be rounded, and maybe they are rounded, right? So if you're paying rent like $1,000 a month, that's fine. I'm not saying to not show rounded numbers if that's the actual expense. But if you have an actual expense of $796, there's no point of rounding, right? You report what you actually spent. Number 9, SCorp owners, make sure you watch my SCorp video. But SCorp owners, if you own an SCorp and there's money going out to you, you got to get paid a salary first before there's any distributions. So the IRS is going to be looking for this, right? They're going to be looking for that W-2, the 940, 941 payroll tax forms. They're going to be looking for that. And then second is a reasonable salary. So if you got a profitable SCorp profits, right? So revenue less expenses of $1 million, and your salary is $50,000 and you're taking distributions of $500,000, you're going to get picked for an audit, right? Because there's an argument that your salary is not reasonable. So you got to be careful about that. But the key one here is just a salary. You got to pay yourself a salary before any distributions. And then finally, just not filing your taxes. So, taxes, it's one of these things that, bugs a lot of people. And trust me, we see it. We do, we prepare a lot of tax returns for people. They have the forms. They get the forms early in January and February, but we get them in April. We get them in May from our clients because it's one of these things, just taxes in general. people don't want to deal with. So if you know that you owe a lot of money to the IRS and you don't have the money, file your tax return. Just file like an extension. You get a 6-month extension. Here's the tax form, because there's 2 types of penalties: not filing your tax return on time and not paying on time. So at least you get this out of the way by filing an extension. And if you don't have the money to pay, there's payment plans you can work with the IRS online, and it's very easy to kind of set up. So here's the top 10 audit red flags. If you have any questions, leave them in the comments below. I'll make sure to answer them. There's definitely others out there, like, meals and entertainment, transportation, use of your car, that can kind of trigger red flags. But these are 10 common ones that we see a lot. Thank you.